In today's video, we are going to talk about how small businesses can use whole life insurance for the owner of the small business and or executives or partners. This is a really interesting topic. This is actually one of my favorite things to talk about because it is my background. Before I got into the business owner world and was talking about life insurance, I was a back office guy that got to design illustrations all day long for corporations, and my goal was to maximize the cash value because the cash value was an asset on the corporation's balance sheet. So the corporation would see the cash value there, and then also set it up so the employees, or the then retired employees, would receive a retirement benefit, which was paid from the life insurance policy, and the death benefit was used to help recover costs. Interesting stuff, right? We're going to kind of hit on that in this video. We're going to look at a specific case study, which is based on a real situation. It's a recent conversation I had with an individual, really nice guy. He's a partner at a law firm. We've been looking at a personal policy and doing the planning for that. But he asked the question, can we use a policy to fund my retirement buyout from my law firm? Right now, my value of the firm, what I own, is approximately $2 million. The buyout will occur in about 10 years. So we're going to look at exactly that. We're going to look at a buyout using a whole life insurance policy to fund his retirement buyout in about 10 years. We'll also look at age 65 just to look at some variety there. But that's what we're going to base this particular case study on. So we've got an individual currently 50 years old. His current value of the company, what he owns, the company is worth more than this, but what he owns is about $2 million. And we're looking at the buyout occurring in 10 to 15 years. So what we want to go through in a case like this, if you own a company, this may be very valuable to you. So benefits to the company, there's more than this, but number one, cash value. That is an asset on your company's balance sheet, especially if you set the policy up where the company owns it. There are ways to set it up where you can fund the policy as the company and actually structure it as a bonus. It's referred to as a Section 179 bonus, an executive bonus plan, where the premiums are actually taxable as income to the executive, but then the executive owns the policy. There's different ways to do it where the company doesn't always own it. In this example, we'll assume that the company does own it. Therefore, the cash value is an asset on the balance sheet, and you've got access to the cash value like a line of credit. Now, if you're using the policy to fund a retirement buyout and you plan on using that cash value before the retirement of the employee occurs, what do we want to make sure of? We want to make sure we have the resources to repay that. We don't want to use it and then run into a situation where we don't have the buyout funds in cash value. Very important there. And some companies elect not to access it for that reason. But continuing on, cash value is one benefit. Life insurance is another benefit here. It provides immediate key man insurance. In addition to that, the life insurance benefit provides some cost recovery. What cost recovery means is when he eventually dies, let's say he retires, he receives his retirement benefit, we'll assume it's $2 million for the sake of simplicity. He receives that $2 million and then dies at age 85. Did you know that you can actually keep the policy in force? So let's say I own the company, I own the policy on you, I fund this policy, we've got $2 million in there. I say, you're going to get your $2 million. Here you go at age 65 or whenever, but there's still cash value in the policy. I'm not funding it. Maybe I still am funding it, but I keep that policy on you with the death benefit. This way, when you do pass, that death benefit flows back to the company and helps recover some of those costs that I have spent on premium dollars. You'll see this strategy executed by companies. So those are some benefits to the company, benefits to the partner, what he's most interested in, that retirement benefit. Now, he's also a partner of the firm, so he wants to see the firm continue to succeed, because what happens if the firm is successful? Well, the percentage he owns right now is currently valued at $2 million. If the valuation of the company increases, what happens to his percentage? It also goes up. So yes, the retirement benefit is nice, but he's also got an incentive to help drive growth of the company, which will increase this. And then also life insurance for the family. We talked about key man insurance. So what'll be nice about this particular case, you'll see we're going to use a $2 million benefit that's payable to him. However, the initial death benefit will be $5 million. So if anything happened to him prematurely, that agreement can be drawn up where at least $2 million or whatever his value of the company is at the time of his death is paid to his family. There's terms you can put into a formal contract in a case like this. That's often what you'll see. You'll see documents prepared for the company, and then the vehicle that's used to support the funding is a life insurance policy in many cases. Other vehicles can be used as well, but life insurance is popular here because of the cash value, but then also the death benefit being paid income tax-free. So from a policy funding standpoint, what we're going to look at is getting $2 million into it, $200,000 per year for 10 years, which will be funded by the company, the firm in this case. But we've got these two words here, flexibility, and then guaranteed values, CFO. What does CFO mean? Chief Financial Officer. So whenever working with companies or a bank, for example, you'll see involvement from the CFO. The CFO will ask for guaranteed values. So if you're looking at a policy for yourself, whether you're an individual or a company, doing what they do is great practice, in my opinion. The guaranteed values, if you do things right with a whole life insurance policy, meaning set it up, the minimum expenses, a minimum premium, one of the 4 major mutuals, we've seen strong cash values that deliver significantly higher values than what we see on the guaranteed side of an illustration. But at the same time, we've got the worst case scenario, which are the guaranteed values. It's beneficial to see that, and it's often requested. So we're going to look at it in this particular case. Flexibility, we'll hit on that because that's very important, especially if cash flow fluctuates. So the retirement buyout options, what we'll look at here is after 10 years, the 11th year, and then also at age 65, which will be after 15 years, the 16th year. Let's take a look, shall we? And we will begin with this. So here's our illustration. What do we see here? Breakdown as to where the money is going. Here's your premium. Here's your term rider. Add the two together and round up. What do you have? About $21,000, just to round off. What do we see going into the policy? If we look at the net premium column, $200K per year for 10 years. Does that mean you're billed for this and you need to pay it at the beginning of every single policy year, no matter what? No, that's not the case. What they can do is set it up where they commit just to the minimum premium, and then PUAs, which is what accelerate the cash value growth, can be added on an unscheduled basis. Now what I'll add here, they want to make sure they've got sufficient cash value to be able to pay him his retirement benefit. They'll need to properly fund it. If you set the policy up with a minimum premium and never add anything extra, that's where we won't have sufficient cash value to pay out that benefit down the road, and we need to come up with the cash from other sources, which some companies will do. They'll use their policy cash value partially and perhaps other assets as well. So here's our growth illustration, but let's take a look at a simplified version of this, which is this guy right here. So what we have is as follows. The exact same thing we just looked at. Here's what we saw, the non-guaranteed values, based on the present dividend interest rate. Annual funding, but we've got a cleaner breakdown as to where the money is going. The minimum premium includes both the base premium, that $18,000 and change figure you saw in the illustration, plus the term rider cost. So think of it, here's the minimum amount I'm billed for each year, which can be also paid over 12 months if I wanted to do that. And then here's the additional PUAs I can add at leisure, whether I want to do so through my online portal, whether I want to do so with a check, or whether I want to do so the wire transfer. And this is based on the particular illustration and company we saw. All companies have different rules when it comes to PUA payments. We've got other videos on that, but I don't want to assume that you've seen all of those other videos. If you're interested in something like this, the company selection plays a very, very critical role. And Guardian is not the only company we use or recommend. That's one of the major mutual companies that we like, but we're fans of any of the major mutuals. So what we've got here, there's the non-guaranteed values. Here's the guaranteed values. And there's reports we can add to this if we're going to look at the internal rate of return or cash value growth. But this does show if I fund it at $200K per year, assuming I make the payment at the beginning of each year, go back to the illustration, you'll see these values match up. We just dropped it on Excel. There we go. Those are the guaranteed values there. If we committed to the minimum and added additional funds sporadically over the course of the year, actually it would be less than this, which is beneficial to be aware of. Another thing with respect to the flexibility. So this models or illustrates 200K per year going in, but they could do something like this. Let's say the first year they're paying 200. Second year, they get a total of 50K in because things are slower. Then the next year, they say, hey, we just had a good year. We had a huge settlement come in. We can pay 200K, but what about the prior year? Can we make up for lost time? The answer is yes. They could pay in 350K. They can catch up payments. And that can be extended if I do 50 several years and then want to throw in $800,000, provided you still have a term rider attached with a Guardian policy, you can do that. So we've got other videos that go into detail. But I don't want to rush through this too quickly, but my point is, what we want to make sure of from a funding standpoint is that the policy is very flexible. Because the last thing a company wants, or an individual wants for that matter, is to feel like they're on the hook for this large amount where they feel, hey, we know we need to fund the policy with this dollar amount for this plan to work. However, our cash flow is not so consistent that we can do that in our sleep, especially if we want to do this for 5 partners. Now all of a sudden what happens? That 200,000 becomes $1 million. We are confident we can hit that, but we would like flexibility because there's years that our revenue might be down 30%, and then there's years it might be up by 50% if we have a huge settlement or something like that. Or if you don't own a law firm, if it's a different company, when money comes in, whatever it is, if you want that flexibility to fund it at your discretion, it's a nice feature to be aware of. And we want to make sure we design the policy appropriately and talk about that too, just so there's transparency and the policy owners have an understanding of exactly how they can fund it, because that's very, very important. And it often opens up the door to larger policies because individuals view it as, okay, if I'm not on the hook for this huge amount, I'm actually comfortable having the option to add a little bit more. And many times they do. But with all that said, that's the growth. Let's look at different payout strategies. This will be cool. What we'll begin with is year 10, or right after year 10. $2 million lump sum paid out. There we go. So when the $2 million lump sum is paid out, what do you see? Well, year 10, cash value is 2.3. Here we just took a withdrawal. There's $2 million. Then we just let the cash value ride. The death benefit will continue to appreciate. Partner received his money. So we've got the firm, owner of the policy, here in yellow. Partner under gray, everything in purple. So if you're the partner, you got your $2 million. You say, thanks so much, see you later. The life insurance policy is still on you though. So what happens when you pass? If the company is the beneficiary, that benefit comes back to them, which by the way, is all drawn up from the very beginning. There's no shady stuff going on where a company says, let's make sure we still cash out on the life insurance policy when he dies. No, there's going to be a formal contract written to say, if there's still life insurance left over, it may be paid to the company or will be paid to the company, or perhaps a portion goes to the family. Like it can be set up however the company and employee or partner wants to do it. But here's an example. Same 2 million paid out, but spread out over 5 years. What do you notice here? Well, we are pulling money out slower. So if you look at age 80, what do you see here? If you're the company, which one would you prefer? The second one. If you're the individual, the partner, which one would you prefer? Probably this one, the lump sum. However, some might say, hey, I'll take it at $400K per year over 5 years. Depends on the individual. And then here it is over 10 years. So that's cool. Let's look at another one. Here, we've got a $2 million lump sum, same thing we just looked at, versus, look at this, $2.5 million, or 2.25 over 6 years. So, I, the firm, could say to you, the partner, hey, we'll give you the $2 million here, but what you could also do, if you take it slower, we'll give you an extra $250,000. So what it allows for the firm is to keep more money on the balance sheet for a longer period of time. Partner gets more. If I'm the partner, I'm going to look at it and say, okay, over 6 years, I get another $250,000. Can I put that to work and earn more than $250,000 over 6 years on my own? That's how both sides are going to look at it. And it also depends if he's actively investing and playing the game of business at that point in time or not. So it does depend really on the individual. But then we did the same thing here, where we get $2.5 million out. And let me just point to the total funding column here, because this is beneficial to be aware of. Got your annual funding and total funding. Over 10 years, you get $2 million into it. But then the firm, what we're doing, you've got a combination of withdrawals and loans here. When this hits zero, what this represents is the fact that if you're the company, paid in $2 million in total premium and PUA payments, and then you pulled out $2 million through withdrawals and loans, and then another $250,000. So you got what you paid in back plus another $250,000. And this is all based on the present dividend rate. We do like to look at income based on the guarantees and conservative dividends too. But then the same thing there. So paid in $2 million, I got it back, plus another $500,000, and I've got the cash value and death benefit. How's the death benefit paid? Income tax-free. Income tax-free. And when you're looking at corporate-owned life insurance, meaning a company owning a policy, there are some other things we want to be aware of from a taxation standpoint. We are going to look at the structure of the policy, ownership. There's attorneys often involved. I do recommend having a tax attorney involved that really knows their stuff. Typically in a case like this, I'm going to be working with them because we don't provide any tax advice or anything like that. From experience, we know a little bit about it, but we will not provide advice. We do need to get a true professional involved in there, and then we'll help structure the policy accordingly, make sure the proper paperwork and such is submitted with the application to make sure the insurance company has everything documented too. Because when you look at employer-owned life insurance, there are forms and such that do need to be signed before the policy is issued. A lot of times with an individual policy, we can easily make changes after the fact, especially in the first 90 to 120 days. You don't always have that option available to you with company or company-owned plans. So it's important just to have the awareness and really make sure everything's being done properly, which the employer, the policy owner, yes, it's good to have awareness, but to be responsible for knowing everything with technical life insurance policy laws and such is a lot. That's why we'll have other specialists involved in a case like this, because it's a lot of money going in, and it's also, if it's a retirement buyout down the road, we want to make sure everything's set up correctly, like it's people's money that you're dealing with here. So this one's cool because we're looking at an age 65 payout. So this is where one might say, the company might say, hey, if you take your money at age 65, instead of after the 10th year, we'll give you 2.4 million instead of 2 million. And it could even be higher than this because its current value is going to appreciate over time. But we'll give you 2.4 million. Or if you defer it, what we'll do is give you $3.2 million at $200K per year. So we've got the annual income and then total income. If you're the partner, here's the total dollar amount you can see. So then you can look at this and say, hey, would I rather take the lump sum up front? I get 2.4 million and I'm done. Or would I take 200,000 per year through the age of 80, which gives me a total of $3.2 million. And what's really interesting about this, or the company's offering it, look at the cash value and death benefit figures. Here, partner got more. There's also more left over. Which again, who's the beneficiary for this? Yeah, the firm. And then the same thing over here. We're going to run out of space. Through age 90, 150K per year. There we go. Which gives them a total of 3.9. And not all companies will give options like this. It does depend on the company, on the partner, really on the company. How many options do they want to make available? Is it just 2 or 3 for simplicity? Is it just 1? Here's what we're going to give to employees or partners that stay with us. Like, there's different ways to do it. And this is all based on one product, which does have strong guarantees, which is nice. There are other options that, from a non-guaranteed standpoint, offer a bit more potential. One last thing, the key man piece. During the first 10 years, if anything happens to him, let's say at 55, something happens to him, he passes, his value is presently worth $2 million, what would happen? Well, if the agreement is structured properly, you've got proper beneficiaries, or the beneficiaries are set up properly is what I mean when I say that. Let's say 2 million is agreed to go to his family of the death benefit proceeds, and then the remaining, which in this case would be 3 million, goes to the firm. Maybe the agreement is a bit more than 2 million goes. It does depend on the relationship of the company and such. What we would do in a case like this, if someone does not have experience or does not know exactly what they would want to do, is provide some guidance. And what helps from a guidance standpoint is really sharing examples of what other companies do. Here's what others have done in a similar situation to you. Here's some popular strategies or popular ideas that we have seen practiced in the marketplace, perhaps by my peers or something that's very common practice with the insurance companies. But again, ideas help. Just like if you're going to a restaurant, you see different items on the menu, then you see the table next to you, they get some steak, some pasta, you get an idea of what it looks like, and then you pick the one you want. I hope that illustration made sense. In any event, I hope that you found some value in this video. I love talking about this because there's a lot of really, really fun things you can do and really, really valuable things for companies and individuals with cash value life insurance, provided we set it up properly and execute the strategy right. But I do hope that you enjoyed it. Let us know if you have any questions. Feel free to leave a comment below. You can also visit our website, ibcglobalinc.com. You'll see a button entitled Start Here, which will show you how you can work with us if you're interested in a policy. And that is all I have for today. I hope this helps. We'll talk to you soon. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.